Prashant, it's a rarity to have you on ETNA, but thank you for joining us.
Good morning.
Macros are looking challenging. Bad is getting worse. Interest rates are likely to move higher because crude prices and rupee is suddenly not supportive. How would you characterize the environment?
I think if you go back few years, the macro in India was too good. Like oil prices at $40 was too good, it was not sustainable probably. And the way oil prices have normalized, I think similarly the macro is also normalizing, I would say. Current account deficit of 0.5, 0.7% in India is not sustainable in the near term, but we were there few years back. So it was too good to sustain. I think macros are stabilizing. So I would not worry too much about the macro.
When we saw similar circumstances which were at play when rupee was declining, crude was moving higher, we had challenges of high inflation, high fiscal deficit and high current account deficit. The situation is not that bad yet, but can we reach there?
I don't think so, because see, if you go back to 2000, I think 5-6 years back, the current account deficit was touching 5%, and I don't think we are anywhere close to that. Inflation is clearly under control. Then we used to have inflation which was in high single digits, briefly touching even low double digits as well. So I don't think we are anywhere close to that kind of a situation.
The fear of what the ILNFS issue could do to the debt market, I think, is rattling everyone. To your mind, how realistic are these fears?
See, I think yes, ILFS is significant, and but I don't think it will upset the whole system. And so there is pain there, but I think it is the fixed income papers of ILFS are very widely held. So all the holders will experience some pain, and I don't know what will happen going forward, how resolution will take place. But I don't think it is so large as to upset the entire system.
What about HDFC MC's positioning in ILNFS?
No, we have had no exposure to ILFS.
The other challenge is that is liquidity getting tight? Do you think there is a certain big asset liability mismatch within the debt market or within the system?
See, I think NBFCs are differently positioned than banks. And see, banking is a business where you need to focus on both assets and liabilities. And last few years what has happened, because liquidity was good, wholesale rates were virtually the same as retail cost of funds, NBFCs did extremely well. Wholesale borrowers were not at a disadvantage compared to those who have retail franchise. I think those times are changing for sure. So I think there should be moderation in growth rates going forward. Even margins could come under pressure. And if this happens, I think the equity markets, which have been very positive on this space, I think they will also realize that banking is, you need to focus on both the assets and the liabilities, which they seem to have forgotten over the last few years.
So do you think NBFCs in general, they reached the so-called Humpty Dumpty levels, both in terms of over ownership and also in terms of outperformance, and now this is simple mean reversion?
I think, see, longer term, I mean, I have always felt, and I was kind of wrong for a few years, I have always felt that a bank which has a good solid retail liabilities franchise is integral to a strong financial institution. And I think that will come to play now. So I think this situation where very large banks who no doubt have NPA challenges, they were trading at sharp discounts to the wholesale funded institutions. I think that should correct.
So if I look at the credit market in India, there are three large parts to it: government, corporate and retail. In last 4 or 5 years, the retail borrowing has gone higher. Corporates have delevered their balance sheet and government did not expand. Now, are you of the view that the cycle could reverse?
So I think it's a very interesting point what you raised. The household leverage has certainly gone up. If you look at last 5-6 years, the retail debt to GDP has gone up from about 12% of GDP to almost 18%. I think this is due to both a different approach to life, the way younger generation thinks. They don't want to save and consume, they want to borrow and consume and pay back later. And also the NBFCs particularly, I think they grew extremely fast, and they mainly led by retail loans. I think that phase should moderate, and going forward, if you look at the net household financial savings, the way it is fallen in last few years, and fiscal deficit is stable, it is not falling anymore. And as you rightly said, corporate borrowings will go up as capex is clearly reviving. I don't think there are enough resources for all these three entities to borrow. So I think retail borrowings will go down. I also feel that bank deposit rates will keep on moving up for some more time. And when you start offering higher interest rates, it is an incentive for you to postpone consumption, for you to save more. And I think the country needs that. People need a higher incentive to save, and probably a slightly higher incentive to push back consumption. So I think higher deposit rates will offer that, and I think we are moving in that direction.
So that brings me to my next big question. And looking at your current portfolio, which is available in the public domain, you've been owning corporate banks for the longest time now. Some would argue that it was a painful call, or must be a painful call for 2016 and 17, but now outperformance has started. So what makes you bullish on corporate banks?
So as I said, we are moving to a situation where the borrowing needs of the economy are probably slightly in excess of the net surplus of savings that is available. So I think institutions that have access to granular retail deposits will be at an advantage, and I think wholesale funded institutions, especially those who have ALM mismatches, I think there could be some need to realign their balance sheets there. And I also feel finally we have all indications are that the NPA situation, the corporate NPA situation is now under control, and in fact it should rapidly improve going forward. If you read the papers, SR, the bids are extremely high. There should be virtually no haircuts as of now, and it's a very large account. It's a 50,000 crore ballpark account. So just imagine the kind of impact it will have if you do manage to recover that. So I think NCLT has been a very good step. I think most banks have now guided for a near normalized level of profitability in second half of this year or next year. So I think if you keep that in mind, these banks do appear to be reasonably well.
So there is a case for, when I say PE price to book in this case, an ROE expansion for corporate banks clearly.
I think it will happen. It will converge with retail banks. In fact, I also feel.
So you expect retail banks to come down?
See, I think the models. See, we should focus on the liability franchise in this market, and I think what might also happen is, as corporate NPAs come down, we need to be alert towards retail NPAs. See, what is happening clearly is retail leverage has gone up, and now access to those loans will come down, because the NBFCs will be constrained to grow from resources. So if easy loan availability is no more there, it may lead to some increase in NPAs as well in the retail side. So I feel this wide gap what we have between retail banks and corporate focused banks, that should certainly narrow now over the next few years.
2 years ago when we interacted on the same forum, you were very clear that you don't want to buy consumers. It was an underweight position for you, and pharma was also an underweight position for you. Consumers have corrected and pharma has gone higher. Let's revisit those two sectors.
No, I would say that pharma has certainly corrected sharply from the highs. Yes, from the bottom it has bounced back, and I don't have a very clear view on pharma now, because I think it is neither too cheap nor too expensive in my opinion. I think as far as consumer is concerned, there are two segments there. One is the consumer discretionary and one is the consumer non-discretionary, what we call the FMCG. I just feel, I have no very strong numbers behind it, but I feel that in the current environment, when retail loans are all set to moderate, interest rates are set to go up, borrowing costs will go up, I think the consumer discretionary spending should moderate, which will actually be very good for the economy, because the high current account deficit is a direct result of very high growth in consumer spending. And the government is also increasing customs duties on few consumer discretionary items. So I don't think it will be negative. But if growth slows down, I think the current prices, even after a meaningful fall in last few quarters, I think are still not discounting lower growth rates. So I feel that there could be still some, I mean the outlook to my mind is mixed or not so good. The consumer staples, I think they will continue to report stable growth rates. That's the nature of no one borrows to buy a soap or a shampoo or a toothpaste. But I just feel that the multiples are there very high. And when profit growth becomes more broad based, some people may want to move into these sectors which are cheaper and now beginning to grow faster. So I would still not be very positive on the consumer discretionary and the non-discretionary.
So consumers can go through a time-wise correction and also price-wise correction, because the growth slows down, earnings compression will kick in.
It could be both, and I don't think we can forecast that. It could be both. It would depend. In the past, what we have experienced is that consumer staples, the FMCG, experiences more of time correction. But sometimes you have seen price correction also. But the consumer discretionary space in the past has delivered more price correction.
2 years ago, you went underweight on consumers, and you pretty much have not changed your thesis around it. Your view has been consistent, and that's what makes HDFC AMC a differentiated AMC. But I'm sure that call must have hurted you in 2016 and 17.
So see, yes, I mean it definitely. So we are focused on the medium to long term. We have always told investors, whenever you are investing in equities, think 3-5 years and probably even longer. Timing is not in anyone's control, neither in my control nor. So what we are saying is we are trying to assess the fundamentals over next 2, 3, 5 years, and accordingly we are making portfolios. And we must also appreciate that all of us live in a dynamic environment. Things change. Oil one day was 40, oil one day was $80 today. Steel prices fell to all-time lows or 2-decade lows in 2015 or thereabouts. So what recovery you were expecting got pushed back. So I think, but still I have seen that if your understanding of the business is correct and you take a sensible view of valuations from a longer term perspective, if not over 2 years, over 3 years, 4 years, I think those views tend to come out right.
Another, I would say brave, because to buy metal stocks 3 years ago, 2.5 years ago, indeed was brave. You bought a lot into steel companies. Is the cycle looking vibrant for metals and especially for steel?
So let me put it this way, if you look at Nifty, in my opinion, barring the consumer discretionary and the non-discretionary space, I think most of the other sectors either look fairly valued or undervalued.
That's an interesting point,
yes.
Excepting consumers.
Except consumer discretionary and non-discretionary. I feel India's market cap to GDP is very reasonable. So, and many people are confusing the markets with a bad macro or I would say normal macro. It looks bad compared to where we were 3 years back. But I think for markets, the profit growth, the micro matters more than the macro. Last few years we had great macro, then why did markets not do well? And now when macro is normal, why are markets doing well? Because profit growth is coming back.
You are a firm votary of cycles. Over the years, I've looked at the presentations from HDFC AMC. Your interaction seems to be indicating that you believe that every market has a cycle. It was TMT, followed by commodity and expansion in some of the capex themes. Then came consumer, now NBFC. So next 3-4 years, what is the big cyclical trend or cycle according to you?
So I think what we have experienced is that some sectors which are delivering very high profit growth in the near term tend to develop a popular following and they tend to become overvalued. And sectors which are passing through a pain period, they tend to become undervalued. And I think this keeps on repeating. So if you look at last few years, some of the most stressed sectors have been metals, corporate banks, capital goods, capital spending. And I think these are the sectors which to my mind look quite, we are overweight these sectors and the outlook is reasonable. I think utilities is another sector which experienced moderate growth for last few years for at least in some companies. And I think if you look at some of these stocks, they are trading significantly below longer term averages. So as I again said, barring consumer discretionary, non-discretionary, most sectors look to be either reasonably valued or undervalued. And I think we should focus on micro for profit growth and what are we paying rather than get distracted with the macro. And incidentally, lower rupee and higher interest rates are good for Nifty's profit growth. So most people miss that. If you look at a depreciating rupee, it positively impacts sectors like IT, pharma, metals, oil and gas, because a dollar of GRM was 60 rupees, now it is 70 rupees. So these are sectors which are positively impacted, maybe a few more. Banks and utilities are not impacted because they have no currency does not move. So there are even FMCG tends to benefit in an indirect way, because lower rupee means more inflation means higher consumer prices, so your nominal growth will actually go up. So I think if you look at it this way, 70-80% of Nifty is either positively impacted or not impacted by rupee. Similarly, if you look at interest rates, while normally, and it is right also, that higher interest rates are not good for economic growth, but I think if interest rates go up moderately, it does not impact economic growth as much as it impacts positively the banks.
Yeah.
So, and if you look at the Nifty, banks are the single largest component, and most of the banks there are liability rich banks. So I think their margins, the pricing power has come back to banks, margin should expand. So I think moderately high interest rates are not bad for Nifty EPS. And another interesting point which you referred to earlier, corporate leverage, at least in large caps in Nifty, is very low right now. So software has a net cash balance sheet, pharma has hardly any leverage, cement companies have low leverage, automobile companies in India, except one, are sitting on net cash balance sheets. So higher interest rates are not just good for banks, but they are also good for all these low leveraged or net cash balance sheets. So I think it is.
So in this year, small and mid and small cap stocks, they got smoked. You are sounding constructive on Nifty, and if one works with the assumption that if Nifty outperforms, that means mega caps and large caps will outperform. So can I safely say that a 3-year long, vibrant bull market in small and mid cap stocks is over? Now it will move to large caps?
See, I think what we have always said, that small caps, large caps, mid caps, they are all part of the same economy. And longer term, the profit growth and the stock performance should be close to each other. But what happened last few years, because some of the sectors that were adversely impacted in terms of profits were like corporate banks, metals, capital goods, they typically are large cap companies. And driven by retail loans, driven by low wholesale rates, driven by rapid growth of NBFCs, consumption continued to grow very rapidly, which also impacted auto ancillaries and things like that. So I think net that space did not experience any profit challenges. In fact, it experienced acceleration, and that is why a lot of money moved into that space. I think that should now normalize. It is normalizing. So profit growth in large caps in the stressed sectors is coming back, and because of challenges which we discussed earlier, I think the growth rates in other spaces should moderate. So I think this should converge, and we have always advised people to keep 2/3 to 3/4 exposure to large caps from a long-term perspective, and the balance to small and mid caps. Small mid caps do have the potential to deliver higher returns once in a while, because and the choice is very large, so fund manager can actually do a good job there. But I think they are also exposed to risks of sharp deterioration in sentiment. I think currently, I feel ki you could look at your asset allocation between small mid on one side and large caps on the other. Given the large flows in small mid cap in last few years, one feels that many investors are probably slightly more exposed to or underexposed to large caps. So I think they should keep that in mind and work accordingly.
A broader message for our viewers. When you see a gut-wrenching fall like this, suddenly when stocks are down 10, 15, 20% in a compressed period of 2 or 3 weeks, it just puts you on a back seat. Your confidence of thinking long term, even though your objective is long term, gets slightly shaky. So can I get a broader message from you that how should investors read this market decline? I mean, is it time to revisit equities? Is it time to cut your steps? What should investors do who are feeling a churn in their portfolio, feeling heat of the sell-off?
Yeah, I think this highlights few things once again. One, it brings out that equities is not a one-way street. That's why we always say equities are a volatile asset class in the short to medium term. Focus on asset allocation, do your risk budgeting, and accordingly invest in equities. I think it also highlights if you have maintained a good balance between large caps and small and mid caps, if you have maintained reasonable quality portfolios, and more importantly, if you have maintained diversified portfolios, the impact would be much less. So I think, I mean, a 5-10% fall in Nifty, to my mind, is very normal, and there is no year where Nifty does not move up or down at some point of time by 10-20%.
2017 spoiled us actually.
Yeah, I think, I mean, see, last few years volatility was lower than normal, but I don't think that you can assume that for future. So I think if you follow the basics right, whatever is your long-term risk capital, where you can tolerate volatility, you invest that in equities, maintain a reasonable mix between large caps and small and mid caps, and go to direct stocks only if you really understand. See, what I have experienced is that I am not saying for all, but a vast majority of investors, I feel, see, when does a sector become very popular? IT became popular after it had delivered mammoth returns in the previous 5 years. Real estate, infra did the same around 2007-8.
Consumers.
Last few years we have seen the same repeat, whether it was NBFCs or pharma or FMCG, in turns or small mid caps. So I think this should remind us once again that equities is not simply about chasing those stocks which have delivered huge returns in last 5 years and avoiding those stocks which have not done well. There is more to equities than that, and that is why I think people should really reassess, and like you go to experts in all field. I think if you are doing well, great, but if you are repeatedly not satisfied with what you have achieved, I think mutual funds have done a fairly good job in India, and probably you can look at that.